Welcome to Iron Financial. Listen, this is the only explainer out there designed specifically to help you forge a visibly stronger portfolio and literally cut through all the market weakness we're seeing right now. I'm your lead analyst, and today we are looking at an absolute behemoth, a massive piece of market architecture. We are doing a complete, no-nonsense structural breakdown of AbbVie's crucial Q1 2026 earnings. And look, when you are evaluating a pharma giant of this immense size, especially one that is actively navigating the most notorious patent cliff in pharmaceutical history, you can't just look at the facade. You can't just trust the curb appeal. You have to aggressively inspect the foundation, look at the load-bearing walls, and see if this building is actually going to hold up when the market gets volatile.
Exactly right. And I'm the market skeptic. My job here is to ask the really hard questions that I know you at home are screaming at your screens right now. Is this company actually structurally sound, or are they just slapping a fresh coat of paint over a crumbling foundation to keep Wall Street happy? Because we've all seen the flashy headlines, right? We've seen the endless analyst hype on the news networks. But here at Iron Financial, we don't buy the hype. We buy the structural reality. And today, we are going to find out if AbbVie is made of iron or just wet paper.
So, here is our drill-down blueprint for today's structural test. 1. We're checking top-line structural integrity. 2. We'll examine the immunology heavy lifters. 3. The neuroscience and oncology beams. 4. We're reviewing the pipeline blueprint. And 5. We'll give you our final verdict.
All right, I am issuing a direct challenge to you right out of the gate today. We have a $15 billion quarter on the table here. Let's just pause on that. That top-line number is basically the gross domestic product of a small island nation. It's massive, but in this ruthless, unforgiving market environment, pure revenue doesn't automatically equal structural strength. So I want to know, and the viewers want to know, is this just complex financial engineering masking a fatal bleed in their legacy products, or is this a genuinely solid foundation built on sustainable, repeatable growth? Are they actually building something durable here, or are we just staring at a $15 billion house of cards waiting for a strong breeze? That's absolutely the right question to ask, and frankly, it's exactly why we don't just sit here and take management's word for it. To really answer that, we have to grab the sledgehammer, strip away all the corporate drywall, and look at the actual accounting studs holding this entire $15 billion quarter together. Let's inspect those financials.
Section 1 of our blueprint, top-line structural integrity. We're inspecting the core financials.
Okay, wait, let's stop right here. Because before we even get a chance to talk about the revenue, the bottom line is flashing red. It looks like a massive, terrifying crack in the armor. Look at this. Q1 GAAP earnings per share came in at just 39 cents. That is a brutal 45.8% drop. Their earnings literally almost got cut in half. How do you possibly justify a structural collapse like that and still sit across from me claiming the foundation is solid? You can't just casually wave away a 50% haircut on earnings like it's nothing.
I totally get the panic, but I can justify it because you're only looking at the raw GAAP number without understanding the massive capital expenditures that actually drove it down. It is a highly deceptive GAAP. You need to pivot your eyes over to the adjusted EPS. Look at it. It sits at $2.65, which is actually up 7.7%. So no, this isn't a structural flaw. It's what I call a planned renovation. The company is actively laying out heavy capital for future load-bearing capacity. Now that hits the GAAP numbers immediately. It looks ugly on paper, but it does absolutely not reflect the daily operational cash flow of the underlying business.
Let me show you the receipts. Here's exactly what caused that terrifying 45% GAAP drop. The single defining factor is a 0.41 per share hit, specifically related to acquired in-process research and development. You'll see it called IP&R&D and milestones expense. We're talking about an incredibly specific $744 million pre-tax expenditure.
Wait, so they basically just spent $750 million on acquisitions and milestones in a single quarter? Look, I suppose to a pharmaceutical giant of this size, $744 million might just be a rounding error. But to an everyday investor trying to build an iron portfolio, that is a massive, massive outflow of cash. What exactly did that money buy them?
It bought them external R&D, it bought them totally new strategic partnerships, and most importantly, it bought them biotech blueprints. Listen, this is the mandatory cost of doing heavy lifting in the pharmaceutical sector today. You simply cannot invent every single molecule in-house anymore. It's impossible. Sometimes you have to go out into the market and acquire promising blueprints to ensure your pipeline doesn't dry up. So that gap drop isn't a crack in the foundation at all. It's literally the cost of pouring new concrete. When you adjust for these calculated strategic investments, their operational earning strength is actually incredibly robust.
And that brings us to the ultimate proof of their top-line structural integrity. $15.002 billion in worldwide net revenues for the first quarter alone.
Look, $15 billion is undeniably a massive, massive beam supporting this business. You can't fake that much cash. But we are living in a high-inflation, highly volatile environment right now. I need to know how that number actually compares year over year. Is this business actually expanding its footprint, or is it stagnating? It's rock-solid expansion. That figure right there represents a 12.4% increase on a reported basis, or 10.3% operationally. And let me just take a second to explain why we strip out currency fluctuations to get that 10.3% operational number. The strength of the US dollar can artificially suppress overseas revenue figures on a spreadsheet, obscuring the actual real-world volume of drugs being sold. When you isolate the pure operational sales volume, you see double-digit growth at a $15 billion scale. That is the exact definition of structural integrity. They aren't shrinking, they are aggressively expanding the square footage of this company.
Let's move to Section 2, the Immunology Heavy Lifters. We're talking Skyrizi, Rinvoq, and the infamous Humira bleed.
Now, immunology is without a doubt the absolute main load-bearing wall for AbbVie. Global net revenues in this specific sector hit an astounding $7.290 billion. But we really need to analyze exactly what products are doing the heavy lifting to support that massive wall. As you can see, Skyrizi is doing staggering work, bringing in $4.483 billion globally. Then, Rinvoq is providing a secondary, absolutely crucial primary pillar at $2.19 billion. And then, way down there at the bottom, you have the legacy asset, Humira, sitting at just $688 million.
Just $688 million for Humira? Look, we really need to pause here and acknowledge how historically massive this shift in architecture is. Humira used to be the bedrock of this entire company. It wasn't just their best drug, it was literally the undisputed best-selling drug in the entire world for years. Seeing a titan like that produce under $700 million while the new kid, Skyrizi, does $4.5 billion, that is a complete top-to-bottom architectural overhaul.
And frankly, here is exactly what I am incredibly worried about. Humira is experiencing a severe 38.6% operational bleed. Cheaper biosimilar competitors are absolutely flooding the market and eating it alive. I mean, think about it. If the foundation of your actual house was eroding by almost 40% because of aggressive structural corrosion, you would panic. You'd be calling contractors in the middle of the night. How on earth is AbbVie surviving this notorious patent cliff without collapsing entirely? They are surviving it because management saw the corrosion coming and engineered replacement pillars years before the old one crumbled. Yes, Humira is bleeding out to biosimilars. There's no denying that. But literally everyone in the market knew this was coming for a decade. Look at the structural offsets. Skyrizi surged 30.9% on a reported basis. Rinvoq surged 23.3%. The sheer volume of new revenue being generated by Skyrizi and Rinvoq isn't just patching the Humira crack with some cheap plaster. It's literally pouring thousands of tons of reinforced concrete right over it. Think about this. The total immunology portfolio still grew 16.4% despite the massive historic Humira collapse. That is textbook structural reinforcement.
Let's look at Section 3, the neuroscience and oncology beams, reinforcing the portfolio.
Any architect will tell you, a strong building requires multiple load-bearing points. We absolutely cannot just rely on immunology. The good news? The neuroscience beam is showing explosive strength. Total global net revenues here hit $2.875 billion. That's a 26% reported increase. Look at the breakdown. Vraylar is up 18.4% to $905 million. Botox Therapeutic continues to be an absolute juggernaut, up 14.9%, doing over $1 billion in volume entirely on its own.
Yeah, Botox is incredibly reliable, we all know that. But for me, the migraine portfolio is what actually proves they can still innovate. Look at these numbers. Ubrelvy is up 41.2% operationally, but Quipla is the absolute standout here, showing a massive 51.3% jump to $296 million. And Vyalev is up over 100%. Listen, these aren't just incremental, slow and steady gains. This is outright hypergrowth. Exactly. And that's why it matters. When your primary pillar, immunology, is actively dealing with a massive transition, having a secondary pillar growing at 26% provides immense, critical structural stability to the entire enterprise. It keeps the roof from caving in.
Okay, hold on. Let's halt the celebration for just a second. We have to inspect the oncology beam. Negative 24.7%. Ouch. That is a severe structural degradation in Imbruvica, which dropped all the way down to $556 million. You cannot just ignore a quarter-over-quarter collapse in a major oncology asset. It looks like it's getting totally outflanked by newer BTK inhibitors that are just grabbing market share. That beam is corroding incredibly fast, and it is a liability.
You're not wrong. I fully admit the Imbruvica crack is totally real. The oncology portfolio as a whole was slightly down, decreasing 0.2% on a reported basis to $1.631 billion. But again, look closely at how management is aggressively applying load-bearing patches to fix the problem. Venclexta grew 15.7%, bringing in $770 million. And more importantly, Elahere grew 10.7% to $198 million.
Okay, so Imbruvica is fading fast, but Venclexta is stepping in to absorb some of that heavy load. But what exactly is Elahere doing for this foundation? Why is a $198 million drug so important?
Because Elahere is an antibody-drug conjugate, or an ADC. Think of it as a highly advanced smart bomb that delivers chemotherapy directly to the cancer cells while sparing the healthy tissue. It represents the absolute next generation of oncology structural technology. So while it's not a perfect offset right this second, like we saw in immunology, these modern, high-tech patches are absolutely preventing a total collapse of the oncology revenue stream while their broader pipeline develops.
Let's look ahead. Section 4, the pipeline blueprint, forging the future.
Lead analyst. We need to see if their forward guidance actually holds weight, or if they are just building future projections on sand. This right here is their step-by-step regulatory roadmap. Notice that they aren't just sitting comfortably on their current approvals, they are aggressively expanding the utility of their existing heavy lifters. Step 1, an FDA application for Skyrizi in Crohn's disease. Step 2, Rinvoq for severe alopecia areata. Step 3, a combination regimen of Venclexta and acalabrutinib for leukemia. I have to admit, this is incredibly smart structural engineering. This is what we call indication expansion. Taking an already approved, proven drug like Skyrizi or Rinvoq and getting regulatory approval for a completely new disease is massively cheaper and way faster than trying to invent a brand new molecule from scratch. It is brilliant efficiency. But I still need to see the structural load tests. You can submit paperwork to the FDA all day long, but does the drug actually perform under extreme pressure?
The data absolutely delivers under pressure. We have the load test data right here for Rinvoq and severe alopecia areata straight from their phase 3 clinical trials. The primary endpoint they were looking for was a SALT score of 20 or less at week 24. Now, for the non-medical folks, a score of 20 or less means the patient achieves 80% or more scalp hair coverage. Wow. The data completely speaks for itself here. The placebo response is virtually non-existent. Only 1.5 to 3.4% of patients saw that level of regrowth on a sugar pill. But the Rinvoq data, that is heavy duty. The 15 milligram dose hit around 45%, and the 30 milligram dose hit all the way up to 54%. Exactly. Up to 54% of patients achieve substantial scalp hair coverage. And honestly, we really have to acknowledge the human element here too. Restoring 80% of scalp hair for someone suffering from severe alopecia isn't just a clinical metric on a chart. It is a profound, life-changing result. That level of life-altering efficacy drives immense patient demand and extremely high prescription compliance rates, which ultimately forges a highly dependable recurring revenue stream for investors.
But listen, a strong blueprint requires literal, physical infrastructure. You can't just have good ideas. AbbVie is pouring massive capital into real-world concrete and steel right now to ensure absolute supply chain integrity. They just announced a jaw-dropping $1.4 billion investment to build a pharmaceutical manufacturing campus in Durham, North Carolina. Plus, another $380 million investment to build 2 new active pharmaceutical ingredient facilities right in their North Chicago hub.
A $1.4 billion factory is a massive, undeniable commitment. But are these just standard run-of-the-mill legacy factories? Or are they actually building for the future?
Oh, they are building the heavy machinery of the future, no doubt. They are aggressively integrating artificial intelligence directly into these sites. We are talking about AI-driven predictive maintenance to prevent costly production downtime and algorithmic supply chain and yield optimization. They are ensuring that when their next-generation immunology and neuroscience medicines get approved, they have the hyper-efficient physical infrastructure ready to scale production instantly without bottlenecks.
And that brings us to Section 5, the final verdict. Is this an opportunity or is it a trap?
So, we've inspected the foundation, we've tapped on the load-bearing walls, we've looked at the pipeline, and we've toured the physical infrastructure. It is time to synthesize all this data. This number right here is the ultimate proof of management's confidence in their own structural integrity. AbbVie actually raised their 2026 adjusted EPS range to between $14.08 and $14.28.
I really have to point out to everyone watching how absurdly rare this is. Think about it. You absolutely do not raise guidance if your house is sinking into the mud. They absorbed a massive $744 million IPR&D expense hit. They stood there and watched their historical flagship product, Humira, bleed out by almost 40% to biosimilars, and yet they still had the audacity and the structural strength to raise their full-year profit outlook? That tells me their internal engineering metrics are flashing bright green across the board behind closed doors.
Absolutely. The cold, hard data aligns perfectly with CEO Robert A. Michael's statement right here. Our pipeline progress and solid business fundamentals position AbbVie for robust long-term growth. Look, I'll be honest, I came into this analysis highly skeptical. I expected a crumbling house. You see a 45% GAAP earnings drop in the headlines and a 40% collapse in the best-selling drug in history, and you logically expect a disaster. But analyzing the complete journey with you today completely changed my view. Seeing how Skyrizi and Rinvoq are practically pouring reinforced concrete over the Humira losses, witnessing the 51% hypergrowth in the migraine portfolio, and understanding the smart ADC patches in oncology, I have to reluctantly capitulate. The numbers absolutely back up the CEO's claim. The fundamentals here are remarkably solid despite the brutal stress tests they are facing.
And that brings us to our final question for you, the focused learner watching this explainer. We've given you the complete Iron Financial drill-down blueprint today. We've shown you the visible cracks in the oncology and legacy segments, but we've also shown you the massive heavy lifters holding the entire architecture up.
The structural data is loud and clear. They boast a $15 billion quarterly foundation, double-digit operational growth, and over $1.5 billion going into state-of-the-art physical infrastructure. But remember, the market is entirely ruthless, and past performance does not guarantee future stability under pressure.
So it's time to look closely at your own financial blueprints. Will you use this structural analysis to actively forge your portfolio with this stock? Or do you look at the data and still see it as a structural liability waiting to collapse under the weight of the patent cliff? The data is firmly on the table. The final decision is yours. Thank you for joining us on this explainer. Stay focused, stay heavily disciplined, and keep building a portfolio made of iron.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.